Hello everyone. Now let's continue our discussion for chapter 5, and we're going to be going over sales. And the first thing within sales is cash sales. So as you know, as a company we can sell products for cash, or it could be on account. So in this case we're going to create what we call it accounts receivable. But in the first part of this section is that we're going to talk about cash sales, where the client or the customer is going to pay us in cash. So a retail business may sell merchandise for cash. In this case, cash sales are normally entered on a cash register and recorded in the accounts. So to give an example, assume that on March 3rd, Net Solutions sells merchandise for $1,800. These cash sales are recorded as follows. We're going to debit cash because we're receiving cash, and cash is an asset, it's increasing, and it goes up on the debit side. And remember, cash is one of the balance sheet accounts. And then on the credit side we have sales, and sales is sales revenue. It's a revenue account, and it increases on the credit side. But remember, sales is not a balance sheet account, that's an income statement account. So as you can see here, since it's an income statement account and it's revenue, it has a positive impact on stockholders' equity. And this is why on the accounting equation here we are representing it under stockholders' equity, because it has a positive impact on stockholders' equity. So you can see the T account for cash is a debit for $1,800, and the sales is a credit for $1,800, keeping the accounting balance, or the accounting equation, balanced. So using the perpetual system, the cost of goods sold and the decrease in inventory are also recorded. So that's one of those things that are different between the periodic system and perpetual system. And by the way, for the sake of this class, we only focus on the perpetual system. The periodic system is available in the appendix of this textbook or this chapter, but again, it's optional for you. I'm not going to test you on this. So using the perpetual system, the cost of goods sold and the decrease in inventory are also recorded. In this case, we have to record two journal entries, one for the sales and one for the reduction of inventory. So unlike purchases, when we buy something, it's only one journal entry because the purchase price is the purchase price. But in the sales transaction, we have to record two journal entries. One is based on the selling price and the other one based on the cost of these items that were sold. So the inventory account indicates the amount of inventory on hand, not the ones on sold. We call that the ending inventory. So to illustrate, assume that the cost of goods sold on March 3rd is $1,200. The entry to record the cost of goods sold and the decrease in the inventory is as follows. So we're going to debit cost of goods sold and credit inventory for the $1,200. So as you can see here, under assets, inventory is going down, so it's credited for $1,200, and then the cost of goods sold is also credited. It's also debited for $1,200. So we debit cost of goods sold, and remember, cost of goods sold is equivalent to an expense account, and inventory is an asset account. So this asset is going down, and the expenses are being recorded. So we debit the cost of goods sold, and we credit inventory. So if I go back to the previous slide, you can see this is the journal entry to record the sales based on the selling price, and you see here the selling price is $1,800, but the cost of these items that were sold was only $1,200. So we have to record these two journal entries, one for the sales based on the selling price, and the other one based on the cost, which is in this case the $1,200. So sales may be made to customers using debit cards, sometimes called bank cards. When a customer uses a debit card, the money required by the purchase is deducted instantly from the customer's bank account. And usually this is the best scenario for any business, because they're going to get their cash transferred to the bank directly without paying any fees or anything like that. So for this reason, debit card sales are recorded as cash sales. We treat it as if we got the cash, but it's even better than cash because we don't need an employee to take it and deposit it into the bank. It already gets deposited into the bank account electronically. Sales may also be made to customers using credit cards such as Visa or MasterCard or American Express or all these kind of different credit cards. So credit card sales are normally processed by a clearinghouse that contacts the bank that issued the card. The issuing bank then electronically transfers cash directly to the retailer's bank account. If a retailer allows customers to use the debit or credit cards to pay for purchases, the retailer may be charged processing fees by the clearinghouse or issuing bank. Such fees are periodically recorded as an expense. And some people might think, oh, what's the benefit for the company then that make them pay such fees? The benefit is huge because, again, you get your money directly to the bank account without having any employees who need to take the cash from the cashier all the way to the bank and deposit it. This is usually one of the concerning things for businesses. It's very risky, and now you do it electronically. And many businesses are willing to pay these kind of processing fees to avoid this kind of risk. So to illustrate, again, assume that a company pays credit card processing fees of $4,150 on October 31st. These fees would be recorded as follows: the debit credit card expense and credit cash. So expense is an expense, so it goes on the debit side, and we're paying cash, so the cash is going to go down for $41.50. Now let's talk about sales on account. A retail business may sell merchandise on account, and again, same concept. The only difference, instead of using the cash account, we're using accounts receivable. The seller records such sales as a debit to accounts receivable and a credit to sales. The other journal entry related to the cost of goods sold is exactly the same like the cash sales. So we'll see this in the next example. So assume that Net Solutions sold merchandise on account to Digital Technologies for $18,000, and the terms agreement are net 30. There are no discounts or anything, but you have to pay it within 30 days. The cost of the merchandise sold was only $10,800. So Net Solutions would record the sales on account as follows. We are going to debit accounts receivable, which is an asset that's increasing, and we credit sales, which is, because it's a revenue, it increases on the credit side, for the full amount that we are expecting to receive, which is $18,000. The other related journal entry, remember, whenever we're doing sales on the perpetual system, we have to record two journal entries. This is going to be always the case, so please remember that. We're going to debit cost of goods sold and credit inventory. By the way, these two journal entries are pretty much standard. The only difference, if it's cash sales, we replace accounts receivable with cash. If it's credit sales, then we use accounts receivable. But this second journal entry is standard. We are going to debit cost of goods sold, credit inventory, based on the cost of the item sold. And as you can see here, the cost is less than the selling price, which is $10,800. So you can guess that the gross profit for this sales transaction is about $7,200. So Net Solutions would record the receipt of Digital Technologies payments on April 9th as follows. So when they pay them the full amount, we're simply going to debit cash and credit accounts receivable. So cash now is an asset, it's increasing, so we debit it. Accounts receivable is also another asset, but it's decreasing in this case because they are paying off their balance, so we're going to credit it for $1,800. Both of these are balance sheet accounts. And you can see that both of them belong to the asset side of the accounting equation. One going up and the other is going down, keeping the accounting equation balanced. Now let's talk about sales incentives, promotions, and discounts. So retailers frequently offer sales incentives, promotions, discounts to increase sales. And that's normal. It's a way of trying to enhance their sales. Discounts may also be offered to encourage customers to pay early, because getting the cash sooner is always a good thing for any business. You don't want to wait too long to get your cash because that would slow down your operating cycle. You want to get the cash very quickly from your credit customers in order to be able to pay back your debt and at the same time make new purchase orders. So sales incentives and promotions are often distributed by retailers through newspapers, magazines, and the internet, and could be also direct mailing. Such incentives and promotions often take the form of coupons and rebates. A coupon provides the customer a discount when purchasing a product, and we all see coupons that we receive in the mail. A rebate provides the customer a refund after the product is purchased. So make sure that you get the difference. A rebate is after I make a transaction, I pay a full price, and then 4 to 6 weeks I get back an amount either by check or other forms. But a coupon, you get the discount right away. The accounting for a coupon or rebate depends upon its terms and how it can be redeemed by the customer. So a coupon has no value, and the retailer has no obligation until a customer purchases merchandise and presents the coupon. As a result, no liability or journal entry is recorded by the retailer when the coupon is issued. So when I issue a coupon, I don't need to worry about it until it's used. Instead, the retailer reduces sales revenue by the amount of the coupon at the time of sale. These type of coupons are referred to as point of sale coupon. So let's see an example. Assume Wellborn Stores offers a coupon on its website for $3 off the customer's next purchase of $15 or more. Also assume that Becky Lou's purchases $45 of merchandise, submits the $3 coupon, and pay cash. The $3 coupon reduces the revenue from the sale from $45 to $42. So assuming the merchandise cost Wellborn Stores $27, how are we going to record this transaction? Pretty much simple. Okay, we're going to debit cash, credit sales as we used to do, but instead of recording 45, we're only going to record 42, which is the 45 minus the $3 coupon. So you can see here that $42 has been directly recorded. And then for the cost of goods sold journal entry, which is the second related journal entry, we debit cost of goods sold for the cost, which is $27, and the inventory on the credit side for $27. You see that $3 did not affect the second journal entry, it only affected the sales journal entry. On the other side, assume that a coupon is issued when customers purchase merchandise. In this case, when the retailer sold the merchandise, it incurred a future obligation or liability to the customer. As a result, the retailer must estimate the dollar value of coupons that will be redeemed, reduce sales, and record a related liability. So here is a different situation because the coupon is issued when the customer purchased merchandise. So let's see an example. Assume that to simulate summer sales, Grande Stores prints a coupon on the bottom of its May 2006 sales receipt for $3 off the customer's next purchase of over $20. The coupon may be redeemed June 1st till August 31st of year 6. During May, Grande Stores sold merchandise for $40 million, which generated $6 million sales receipt. The cost of the merchandise sold was $21,500. Grande Stores estimate that 20% of the coupons will be redeemed before they expire on August 31st. So if Grande Stores accepts only cash, Visa, or MasterCard, it would record its May year 6 sales as follows. They're going to debit cash for $40 million. They're going to credit sales for $36,400. And then their estimated coupon payable would be $3.6 million. So as you can see here, the amount of receipts were $6 million multiplied by 3%, $3 multiplied by 20%. And that's how we got the $3,600,000. That's the estimated coupon payable. So how we're going to show that on the accounting equation. Cash has increased by $40 million. The estimated coupons payable is 3.6. The sales is $36,400,000. So that would keep the accounting equation balanced. The cost of goods sold of these items would be debiting cost of goods sold and crediting inventory for the same value, which is the $21,500. This is directly given from the problem. So to explain this more, as of May 31st, year 6, Grande Stores has incurred a current liability called estimated coupons payable. That's a liability that would be created since we issued these coupons for those sales transactions, the 6 million transactions. So we're going to assume that these coupons are going to be used. So to its May customers who may redeem it, it's $3 coupons. Since it's estimated only 20% of its May customers would redeem the coupon, 1.2 million coupons are estimated to be redeemed. Not everybody who's going to get the coupon is going to use it. Only 20%. That's based on previous experience. And again, accountants, they don't make these kind of decisions. Maybe they help management on making these kind of decisions based on previous data, but usually the ultimate decision is with management. In this scenario, we are given this information that 20% of of the coupons are expected to be redeemed or estimated to be redeemed. So because each coupon is worth $3, the estimated coupon liability would be $3.6 million. How did we get that? We got the 1.2 million coupons multiplied by 3, and that would be 3.6 million. The estimated liability reduced the gross sales of the 40 million because now you really made a $40 million sales, but you also have a liability related to these sales of 3.6 million. So that would reduce your gross sales to 36.4 million. So when customers redeem their coupons, the estimated coupon payable is decreased. So to see the example, assume that during June, Grande stores sold $52.5 million of merchandise that cost $28.1 million, and that 800 of the May coupons were redeemed. Grand stores would record its June sales as follows. They're going to debit cash for $50,100,000. And we'll wait for that. We'll see how we're going to do the math in a second. The estimated coupon payable were $2.4 million, and the sales were $52,500. So see, we had 52.5 merchandise, and like merchandise sales, and out of these 52.5 million, we have 800,000 that use coupon. So 800,000 multiplied by 3, that's our estimated coupons payable. We're going to reduce that, and that would be 2.4 million. So we reduce 2.4 million from the 52,500, and then the net cash would be only 50,000 or $50,100,000. So in this case, our sales, the actual sales, were 52,500. But because of the coupons, we had coupons of 2.4 million, that reduced the amount of cash received to 50,100,000. The cost of goods sold journal entry is just going to be based on the actual cost of goods sold incurred, which in this case is 28.1 million. So Grande Stores would record its July and August sales in a similar manner. Since the May coupon liability is based on an estimate, estimated coupons payable may have a balance on August 31st of year 6. To illustrate, let's assume that on August 31st, year 6, estimated coupons payable has a credit balance of 175,000. So since the coupon period has expired, Grand Store does not have any further coupon liability, so they need to get rid of this liability. So the estimated coupon payable credit balance of 175 should be added back to sales as follows. So we get rid of the liability, and remember, liabilities, when we get rid of it, we put it on the debit side instead of the credit side. So we debit estimated coupon payable, and we credit sales that we actually didn't have, but we previously had for people who made these sales or like purchase our products, and we offered them the coupons, and we had an estimate for that, but they didn't use it. So now the sales are increasing. So the 175,000, if I go back, this is part of our $40 million sales. So not all the 3.6 million were used. There were 125 that were not used, or 175 that were not used. So if on August 31st, year 6, estimated coupons payable had a debit balance of 50,000, so in other words, more people used the coupon than we expected. So Grand Stores would have underestimated the percent of coupons that were redeemed. As a result, Grande Stores would decrease its sales by making the following journal entry. So we are going to reduce our sales a little bit further. So by reducing sales, we're going to debit it, and we increase the estimated coupon payable or estimated liability for the coupon payable by $50,000. So we debit sales, credit estimated coupons payable. So in the previous example here, this is where we underestimated, actually when we overestimated our coupons payable. But in the other situation here is when we underestimated the coupon payable. In other words, we had coupons used more than we had estimated for the 20%. So the accounting for rebates is similar to that for coupons. So we'll talk about rebates. It's very similar. Instant rebates, which are redeemed at the time of purchase, reduce the revenue at the time of the sale. That's no problem. Mail-in rebates, are the ones that need some adjustment. These require the retailer to estimate the dollar value of rebates that would be redeemed, reduce sales, and record a related liability. And as you know, not everybody would send the mail-in rebate in the mail. And I don't know if it's true or not, but companies sometimes they make it a little bit more difficult to complete the rebates. Even though I see a lot of companies nowadays, they have online rebate forms that make it easier for the customers. So, if we talk about sales returns, refunds, and allowances, a buyer may return merchandise that is defective, damaged during shipment, or does not meet the buyer's expectation. If the buyer has already paid for the merchandise, the seller may pay the buyer a cash refund. If the buyer has an outstanding accounts receivable with the seller, the buyer may request an offset against the accounts receivable. A buyer could also keep the merchandise and request a partial refund or price allowance. And again, in business, this happens every day. A lot of customers are not happy with the product, they want to return the product, or maybe they want an allowance, or a price allowance. So all these kind of things are normal in a business, but what we care about now is how we treat it from the accounting perspective. So at the end of the accounting period, a seller must estimate the amount of returns, refunds, and allowances that may have to be issued to customers in the future. Based upon these estimates, sellers record two adjusting entries. The first one is related to the customer refund payable, and the other one is related to estimated returns inventory. So the first adjusting entry decreases or debits sales and increases customer refunds payable for the estimated refunds and allowances that will be granted to customers in the future. Customer refund payable is a current liability for refunds and allowances that would be granted to customers. The second adjusting entry debits estimated returns inventory for merchandise that is expected to be returned and decrease or credit cost of goods sold. The estimated returns inventory is a current asset for merchandise that is expected to be returned by customers. So, let's see an example. Assume on December 31st, year 7, Net Solutions estimates that from their year 7 sales it would have a refund or grant customers allowances of $7,000 during year 8. So Net Solutions estimates that $5,500 of merchandise will be returned. Based upon these estimates, Net Solutions would record the following two adjusting entries on December 31st of year 7. And these are exactly an application of what we had in the previous slide. Some people might wonder why we're doing this. Why don't we just wait until our customers return their items and then we record the returns? The reason behind that is we want to follow the matching principle. So we want to make sure that the returns are recorded in the period where the sales took place. We don't want to record the returns in year 8 while the sales were done in year 7. So that would violate the matching principle. Remember when we have to match revenues and expenses of the same period? So that can create a problem. So, and the problem is that your revenues and expenses are not related. So to do that, we make an estimate in year 7 for how much returns are going to be expected in year 8. So we're going to debit sales and customer refunds payable, and that's on December 31st. Remember, customer refund payable is a liability account for our estimate of $7,000. And then we estimate the returns inventory to have a value of $5,500, so we debit estimated return inventory $5,500, and we credit cost of goods sold for $5,500. With the same idea like in the coupons, assume that on March 4th, year 8, Blake & Sons returned merchandise to Net Solutions with a selling price of $1,800 for a full cash refund. The merchandise originally cost Net Solutions $875. Net Solutions would record the cash refund and the return with the following two entries. So we're going to debit the customer funds payable, which is a liability that we created. Now we're reducing it, we debit it, and we're going to credit cash because we're paying the customer cash or returning the customer's cash for the $1,800. And then inventory is going to increase because the client or the customer returned the inventory, so inventory balance now is increasing, so we debit inventory and we reduce the estimated returns inventory. A buyer who has already paid for merchandise may decide to keep the merchandise and accept a partial refund from the seller. And sometimes this happens if the item is defective or there's an issue in delivery or something like that, and we're trying to keep the customer happy. So assume that in the prior example, Blake & Sons agreed to keep the merchandise in return for a partial refund of $900 from Net Solutions. In this case, Net Solution will record the partial cash refund as follows. We're going to debit customer funds payable and we credit cash for the $900. Notice we didn't do the other or the second journal entry related to inventory. I'll just go back for one slide. See this other estimated return inventory? It's not there. Why it's not there? Because there was no inventory returned. So it's only just the refund or the partial refund to the customer that was recorded. And then there's a credit memo that you usually receive, or actually we send to this credit customer. So you see here our company, we record the credit memo to Blake & Sons, letting them know that we are going to allow $900 allowance for merchandise damage and shipment. So the credit memo indicates that Net Solutions intends to reduce credit Blake & Sons accounts receivable by $900, and Net Solutions would record the granting of the customer allowance as follows. So we debit customer refunds payable and we credit accounts receivable for Blake & Sons under the assumption that this was originally a credit sales transaction. So let me stop here. In the next video we're going to continue discussion about accounting for retail businesses.